Right now, as we watch the markets unfold on this Wednesday, December 17, 2025, Datavault AI Inc., ticker symbol DVLT on the Nasdaq, is trading at exactly $1.36 USD, down 0.030 points, or roughly 2.19% for the intraday session. If you are looking at that price action and feeling a knot in your stomach, you are not alone, because the expectation for anything with AI in the name is usually a vertical green line straight to the moon. Yet the reality we are witnessing with Datavault is a slow, grinding friction that is testing the patience of even the most hardened retail traders. Everyone expects that because we are living through an artificial intelligence boom, every single company that pivots to data valuation or machine learning should be trading at a premium multiple. But Datavault AI is currently forcing investors to confront a much harsher truth about what happens when high-concept technology meets the brutal liquidity constraints of the microcap market. The narrative you have likely been sold is that Datavault is the next big thing in Web 3.0 and asset monetization, a company that is going to turn every piece of data into a tradable commodity. But the chart is telling us that the market is currently demanding proof of execution over press releases, and that disconnect is exactly where we need to focus our attention today. When you look at the last few trading sessions, seeing the stock slip from the $1.40s down to this $1.36 level, it signals a very specific type of exhaustion among early buyers who were hoping that the recent announcements regarding the international NIL exchange would trigger a massive short squeeze or a volume spike that never fully materialized. It is fascinating because when you compare this to the price action in something like Nvidia stock, which effectively set the tempo for the entire sector, you see that the market is becoming incredibly selective. It is no longer enough to just have AI in your corporate title. You actually need to show how that AI is generating free cash flow. And right now, Datavault is showing us growing revenues, but also widening losses. The big story that should be dominating the conversation but is curiously being digested very slowly by the street is the involvement of hockey legend Jeremy Roenick as an advisor, which sounds like a headline you would see in a sports magazine rather than a financial disclosure. Yet it is pivotal to understanding their pivot into the NIL or name, image, and likeness space. Expectation here was that hiring a celebrity advisor would just be a marketing fluff piece, but the reality is that Datavault is trying to build a legitimate marketplace for valuing human capital, literally tokenizing the fame and performance data of athletes, which is a market that is absolutely exploding right now. Yet the stock price is reacting as if this is a non-event, creating a divergence that value investors might call an opportunity, while momentum traders call it a trap. You have to wonder, if the technology is so robust, why are we seeing this persistent selling pressure? Part of it comes down to the mechanics of where people are holding this stock. If you are trading this on the Robinhood app or holding it in a SoFi active investing account, you're likely seeing a lot of retail sentiment that is frustrated by the lack of immediate gratification, and in the absence of institutional support, the big whales like BlackRock or Vanguard stepping in, the price is left to drift on relatively low volume compared to the major indices. We need to talk about the volume because today's movement down to 1.36 isn't happening on massive capitulation volume, which implies that this isn't a panic sell-off, but rather a lack of buyers stepping up to defend the price, a situation that often occurs when a company is in that awkward prove-it phase between launching a product and actually selling it at scale. This brings us to the core business model, which is arguably one of the most complex and ambitious in the small-cap space, blending two things that rarely go together: high-fidelity audio technology and blockchain-based data valuation. It's almost like two different companies mashed into one ticker, and that confusion is likely contributing to the discount we are seeing in the share price today. On one hand, you have the legacy Acoustic Science division with its YSAW technology, which deals in high-definition wireless audio. Think about the tech inside your home theater system. And on the other hand, you have the Data Science division, which is building the Datavault platform to value and monetize data assets using something called Sumerian crypto anchors. The complexity here is a double-edged sword. On the surface, it sounds incredibly sophisticated, almost like something you would hear about if you were researching Tesla stock and their autonomous driving data networks. But deep down, investors are struggling to value the synergy between listening to music and minting data tokens. And when the market gets confused, it sells. The company claims these two platforms are synergistic because they both deal with waves and data transmission. But for the average person using Schwab Intelligent Portfolios or looking for investment help to build a retirement nest egg, that connection is tenuous at best, and it requires a leap of faith that many conservative portfolios just aren't willing to take right now. Let's pause on the recent financials because this is where the rubber meets the road and where the expectation versus reality tension is tightest. They reported a revenue jump of over 140% recently, which is the kind of growth number that usually sends a stock flying, but the reality was a net loss of over $30 million in the same period. You don't need a degree in finance to see that burning $30 million to make $3 million is a ratio that makes people nervous, specifically regarding cash runway and the potential for future dilution. If you were sitting there with your Fidelity brokerage account open, looking at the balance sheet, you're probably asking, will they need to sell more stock to keep the lights on? And that fear of a secondary offering is a wet blanket on the stock price, keeping it pinned under that $1.50 resistance level regardless of how many press releases they put out. However, we have to look at the other side of the coin, because if they actually pull off this international NIL exchange with the World Boxing Council and other partners, the revenue potential from transaction fees on sports data could be immense, effectively decoupling them from the hardware struggles of the audio business and turning them into a pure-play software fintech. It's a high-risk, high-reward setup that is classic for the microcap sector, similar to the early days of SoFi stocks or even Robinhood crypto ventures, where the platform value wasn't clear until critical mass was achieved. Speaking of platforms, it's interesting to see how retail investors are accessing this trade. We are seeing data that suggests a lot of the accumulation is happening via Robinhood fractional shares and Fidelity mobile app users who are treating this as a lottery ticket on the AI data economy. This demographic is typically more patient with volatility, but also more prone to emotional selling if the price breaks key psychological support levels. And right now, $1.30 is that line in the sand. If DVLT breaks below $1.30, we could see a flush down to the $1.10 range as stop losses get triggered across Interactive Brokers trading accounts and other algorithmic platforms. The broader market context is vital here. We are late in 2025, and the macroeconomic environment has shifted from the inflation fears of previous years to a focus on growth sustainability, meaning that speculative tech stocks are no longer getting a free pass just because interest rates might be stabilizing. Investors are demanding profitability or at least a very clear path to it, and Datavault's massive net losses are a sticking point that sets them apart from cash-rich giants like Apple stock, which can afford to burn billions on R&D without the market blinking. When you buy DVLT at $1.36, you aren't buying a safety net, you are buying a venture capital-style bet that is publicly traded, with all the volatility and transparency that comes with it. One specific angle that isn't getting enough airtime is the insider activity. We have seen filings indicating that executives have been selling shares, and while there are a million reasons to sell, tax planning, buying a house, divorce, there's only one reason to buy, and the lack of massive open market insider buying at these low levels is a signal that reality might still be catching up to the internal valuation models. If the management team truly believed that the data score technology was about to become the industry standard for valuing
valuing corporate data assets, you would expect them to be scooping up shares with both hands at $1.30, yet the transaction logs show more distribution than accumulation, which is a red flag that you should not ignore. This is a great moment to check the temperature of the room. Comment below how many shares of Datavault AI you currently hold and what your average entry price is, or if you are staying on the sidelines until they show a profit, because understanding where the community is positioned helps us gauge the potential for a short squeeze versus a long liquidation. Now let's pivot back to the technology, because the Datavault proposition is genuinely intriguing if you strip away the financial noise. They are essentially trying to solve the garbage in, garbage out problem for AI by creating a certified valuation-attached record of data provenance. In a world where AI models are hallucinating and copyright lawsuits are flying left and right against major tech firms, having a certified data set that is tracked on a blockchain is actually a massive value proposition.